Welcome back. Investors have enjoyed a dramatic late-year stock market rally that has pushed major U.S. indices deep into double-digit percentage gain territory so far for the year. Can the rally persist into 2024? Let's bring in Bob Dahl. He's Chief Investment Officer at Crossmark Global Investments. Bob, thanks a lot for joining us. What is your take on this very dramatic late-year rally that we've had?
Pretty amazing, as you point out, after an 11% decline in the months of August, September, October, November, and here the first half of December, we're up 15% here in the U.S. That's like a good year in a month and a half. Momentum, Fed sentiment probably pushes the market somewhat higher. This is a seasonally strong period of the year, so into the new year, we would expect some strength and then maybe some fade thereafter.
Is there a sugar high rush from the Fed's most recent signal on interest rates? Are markets overly optimistic, or have they fully priced in any potential for rate cuts in 2024?
Well, the consensus, as marked by the Fed Fund futures curve, has 6 cuts in 2024. Our guess is we probably won't get that many. We still think inflation is not finished. We haven't slayed the dragon. We think that economic growth will slow and there'll be some earnings disappointment. So the sugar high may, as I said, fade a little bit after we get into the new year.
One sector of the U.S. market you think is expensive are the utility stocks in the United States. They are interest rate sensitive. So talk to us a bit about the utility stocks, and are there other sectors of the U.S. stock market that have maybe moved into expensive or overpriced territory?
So utilities, yes, they move both with bonds and with stocks, as you know, and relative to both, they're fairly expensive. Their payout ratios are on the higher side, so not a lot of room for dividend growth. So that's not an area we're all that excited about. What we do want to own are companies with high earnings predictability, earnings persistence, good cash flow, and you can get that lots of different places. We just be careful of some of the very highly valued stocks. Might have been highly valued before this big rally, and even more so now.
What's your view on technology?
So yeah, I think you need to own some tech, need to be selective. We're still biased to the software area. Microsoft, Adobe would be a couple of names in that area. Tech should not be avoided. Just be careful how much you pay for the tech stocks you own.
You like energy and you like financials. Let's begin with energy. There's been a huge disappointment in the price of crude oil for investors who are long energy. Now, here in Canada, the energy stocks have outperformed that decline in crude oil. They've come off, but not nearly as much as crude oil has, and I suspect it's the same in the United States. What's your take on the energy sector, and do you expect a significantly higher price of West Texas Intermediate crude through 2024?
Higher oil prices, yes. Substantially higher, not necessarily. We think that oil is oversold here. It's obviously, as always, a subject of supply and demand, but we would expect into 2024 somewhat higher prices, which may be a necessary ingredient for these stocks to do well. We like some of the refiners as well. Phillips 66 would be a name. ConocoPhillips is another one that piques our attention.
And the financials, the U.S. financials.
Financials have lagged here in the U.S. this year, as you know. We would own some. We think they're pretty cheap, and their balance sheets, by and large, are healthier than typical into an economic slowdown. So you can go with higher quality like Visa and MasterCard, financial services, insurance, MetLife and Aflac are names of interest. And if you want a bank, we go with a high-quality J.P. Morgan.
What about the regionals, which of course took a major hit in 2023 that the share prices still not have recovered from?
Yeah, less so. Some of the higher quality ones maybe, but as you know, regionals tend to have more real estate exposure, and we're a bit concerned about real estate prices, particularly commercial real estate. Not that the big banks don't have that, but it's a smaller percentage of their assets and their earnings.
You like the healthcare sector as well. Why so, and which parts of the healthcare sector do you favor?
Yeah, healthcare providers, the HMOs in particular, they offer what I mentioned earlier: earnings predictability, earnings persistence, good cash flow. Cigna is a name we like, McKesson, Elevance, so there'd be three, and there are others as well.
What is your advice to investors, broadly speaking, given the rally that we've had late this year?
Yeah, our view is we're going to have more volatility in both directions, and therefore don't chase the big rallies and don't panic out at the bottom. As I mentioned, 3-month decline here in the U.S. of more than 10%. I got a lot of calls. How much should I sell? No, that's the time to buy. And then you get a big rally like this, 15% in a month and a half, and the calls are, what should I buy? And my advice is take your time. We'll have pullbacks. So we would buy the dips and trim the rallies.